All right, folks, I want to talk today about the number one question I often get is, should I buy for capital growth or should I buy for yield? And my answer is very, very simple. It depends. It absolutely depends on what your strategy is. So first of all, I want to make a very key point here. Strategy is number one. What are we aiming for? What's the end game? What are we reverse engineering? We talked about in our book, How to Retire on 2,000 a Week, passive income. Is that your goal? Do you want 1,000 a week? Do you want 3,000 a week? Whatever it is, we need to know what your strategy is based on a couple of things. First of all, we've got a few levers that we can play with. Time, target, income, and expense. So what does that mean? When we're building a portfolio, anyone is building a portfolio. It's like what you've got with the levers when you're moving a crane or a bobcat or a bulldozer. You move them back and forth. How much time do I have until you want to retire? Are you starting young? Are you starting later? What's the target? Is it 2,000 a week? Is it 1,000 a week? How much income do I have? Is there any chance of my income going up? Or is there any chance that my income will be going down? I'm going on a sabbatical. I'm taking a part-time job so I can go and study, all those sorts of things. And the last thing is around expenses. What is your essential and your discretionary spend? Is it high? Is it average? Is it low? Those are the four things that we can play with that help us determine what the strategy is so we can work out what your end game is. Now, when it comes to buying property, I always think there's three broad categories that we can talk about. First of all is to buy a growth asset, which is typically the ones closer into the major hubs, the CBDs, the main built-up areas. The second one is a balanced asset. And you might find a balanced asset, for example, on parts of the Gold Coast, parts of the Sunshine Coast, in certain regional locations, where they're close enough to a capital city job market, so they will still get a bit of growth, but they also have a little bit higher yield as well. And then the third one is income assets, where we're typically getting lots of rent. The cost to buy them is a bit lower. We often call them the cash cows. So the question is, which one should you use? And the answer is really simple. It depends on what your strategy is. So let's have a look at the difference between growth versus yield. So at comparing two that look like this. Now the first one is 8% growth, 4% yield, right? Versus 4% growth and 8% yield. So effectively what we're doing is we're comparing a growth asset with a yield asset. So if we have the growth asset doing something like that, has exponential, and then you've got income through here, and then you compare that with the asset growing through there, and then you have the income that's superior, and then it crosses through under here. I know that's a little bit rough, but the point is, what we're saying is the growth of the asset in capital growth is significant, and then you have this scenario right here at about the 17-year mark where the income from the growth asset exceeds the income from the yield asset. So you can see early on, the fact that you're getting a little bit more income might help someone who is wanting to retire out debt. Say they've got a few investment properties already and the extra income will start to accelerate the debt retirement. Or someone who is on low income, for example, and they cannot afford to buy a growth asset, well, that'll help them retire out some debt. Or someone who's close to retirement, who doesn't have a lot of time up their sleeve, that can also help them in the early days. So it's important to understand that there is no one size fits all. I just want to make that really clear. So the question of, should you chase growth? Should you chase yield? My initial statement is true. It just depends. What's your strategy, what we're chasing? There is definitely no one size fits all. Now, what is it that we're actually buying in the marketplace? Well, we're buying lots of assets that are growth assets, lots of assets that are balanced, and lots of assets that are income, because we're actually using real estate as simply a vehicle to achieve lifestyle design through having an end goal of a passive income that we then reverse engineer and buy. So a typical portfolio may look like this. We may buy 2 assets that are growth assets. We then might buy one in the middle that is a balanced asset, and then we may bring it home with either 1 or 2 income assets. So you can see the capital base is growing via this type of asset. You can see we're starting to level out the income and the debt on this type of asset, and then towards the end of the portfolio, the idea is about retiring out the debt. So there you have it, folks. The question is, should I buy for capital growth or should I buy for yield? The answer is it depends. It really depends on what we're shooting for and the type of asset that is appropriate for the type of strategy that you've put in place. So next time you're faced with the decision on whether we should buy a capital growth property or whether you should buy an income asset, the question really comes down to what is most appropriate for my portfolio right now.